Thank you very much. And we have a wonderful collection of experts along with us here in this post-afternoon session. Not always the easiest time, but I have great co-panelists here to make it exciting and interesting. So without much ado, let me just go quickly around. We have a good mix of GPs and LPs for this panel on co-investing. So let me get started and maybe quickly go around maybe with Ranjit. And for everyone to quickly address, just quick 20 seconds about what you do. And what's your view on co-investments? Is that something which, what's your motivation for co-investment?
Thank you so much and great to be here. So Karthik, our co-investments is an integral part of our strategy, mainly for a couple of reasons. The first is in situations where we want to increase our stake to buy control and yet keep our risk levels to a certain level from an individual fund viewpoint, then we like to invite co-invest. The second is if we want to do larger transactions, Then there is a third specific reason where we do several banks, and due to Reserve Bank of India regulation, we can't own more than 5%, or with special permission 10%. Then we seek to form a consortium using co-invest. And last, the motivation, at least in our experience, has been the ability for co-investors to add value add. So a company that seeks to really expand in, say, the US market. Then we try to find an investor who could help with that. So broadly speaking, higher stakes, higher sizes, case-specific situations like banks, and strategic value add.
When we were just preparing to come here, Karthik actually mentioned one thing, that since this is a post-lunch session, let's actually ensure that we take a stance on whether co-investment is good or not, just to kind of make it spicier. So in the interest of that, I would mention that as a GP, the internal joke that we talk about is that we are in a wealth distribution business, right? So we take money from, wealthy LPs and give it to the startups so that they can create value and a larger wealth distribution could happen. We are more a Series B fund, so typically deploy around $10 to $25 million in companies which we think are post-product market fit. We have had experience of investing with LPs in the co-investment, and also have instances where some of the LPs have directly invested in some of the companies. If I were to really take a stance, I would say co-investment has significant more merits, whereas direct investment probably has a lot more challenges in a country like us, and we'll probably talk about that little more during the course of this conversation.
Thank you. Sachin, you actually don two hats now, both as a GP and as an LP. If you just take your LP perspective, as an LP, what's your motivation to actually look for co-investments? Is that part of your core strategy?
Sure. Thank you for having me here. As Karthik said, LP and a GP because I run a venture FOF for Nippon Life India Asset Management. And our LP base is primarily Japanese, so we focus on the Indo-Japan corridor. Fund 1, we've been only doing primary LP, but we are shortly launching a Fund 2, which will have a co-investment program in it. And the primary motivation for doing co-investments with GP, there are two. One, the biggest factor is the returns. And the other factor is to be an active, which Ranjit mentioned about the strategic value add, which is want to invest in companies which can gain from our Japanese relationships. So there are two factors. One is returns, which is the larger part of it. And the other part is, how we can help those startups gain access to Japan through our, heritage of Nippon Life.
Thank you, Sachin. Aparna, again, a very interesting LP role that you play, where you have a direct team as well, which is actively looking for much larger investments, while you also look at funds and co-investments. So how is your co-investment strategy different from a typical LP?
Sure. Hi, everyone. Thanks for having me here. British International Investments, formerly CDC Group, is UK's development finance institution, and we have a dual mandate of impact as well as commercial returns. We look for investments in inclusion and in climate as the two themes at this point in time. A large part of our investments in funds is based on the co-investments, the hope to do co-investments with them as well in the future. And the primary reason, I mean, there are a few reasons. I would say one is, of course, to give us access to the deal flow in the sectors that we are interested in, to find more and more compelling opportunities in terms of impact as well as in terms of commercial returns. It also acts like a pipeline for our direct side as well. If, let's say we put in a small check as a co-investment and then we track the investment, and if it continues to deliver the, returns as well as impact, then it can become in the future more, interesting for our direct side. And I mean, these are investments which we may not be able to do from a direct side in terms of ticket size or the stage of company, and therefore it becomes much more interesting for us to do it as co-investments with our GPs.
Thank you. We'll come back on that. So Jay, you again as an LP represent a very different approach. As a family office, what's your motivation for co-investments?
I think one of the key things that you've got to keep in mind as a family office, and I think I'll speak a little broader on all family offices, is that they were born out of entrepreneurship. And so there's always a matriarch that's sort of, if you sit with a patriarch, a large patriarch, and you give him his deck, it could be whatever, hundreds of million. If you spend time with him, he hardly spends 5 minutes. He looks at the number, says, okay, now tell me something interesting, because it's done, right? So he exited his business. That fire of entrepreneurship and the risk-taking is why I think today family offices, including ourselves, are looking at co-invest. So see, it's a new asset class, whether it's VCP in India, I still feel we're still starting, right? And for a family office to be able to taste that risk again, to taste that excitement, that innovation, is a big thing. So they'll deploy, today we are seeing deployments across funds. Then the subsequent thing, I think it's still early days. They all want co-invest. How many of them will go ahead? It's a question mark, right? But the reality is for them, if it's a domain, if, for example, for us, fintech and proptech is important because for also the businesses that we have. It's great for us to add value to start with the GP that I invested in, to his portfolio company. It's again paying me back, right? If he succeeds, I open some doors, he gets POC options. So I think there's a lot of synergies. And so today we look at it as supporting our GPs. We look at it as getting innovation, great ideas, new age ideas. I think India, from what it was 20 years ago to now, internet to mobile to ChatGPT, right? We have a whole bunch of stuff happening. So I think it allows the families to also bring in the next gens. The next gens don't really want to sit at a factory floor and monitor 10,000 employees and then have to deal with why was sambar served versus chola, right? That's not the game. They rather say, I want to sit in a fun place like this VCCiRCLE conference with so many other brethren from the society and say, let's put some money in some innovative stuff.
All right. So as we heard, very different motivations from different people. Let me just go one step further and let's try to put some numbers to this. So Ranjit, you have been kind of driving a very strong, active co-investment program for some time. If we have to put some numbers and say, what part of the investments are going as co-invests, how do you look at that? Any numbers and quantification that you can throw light on?
So of course, this will vary by fund and by fund strategy and fund size, etc. But in our case, around 25 to 30% of our cumulative investments we've offered that much for co-invest to our LPs. They've all been LP co-invests. And, since you're talking of numbers, let me give you a background statistic. There was a study done by BlackRock, which found that should an LP get about 25% co-invest, then it advances the J curve, for costs in funds by about 12 to 18 months. So it's quite interesting. I think a lot of LPs, therefore, are very keen on this, from a cost efficiency viewpoint. It should be an increasing trend. I'm sure that everyone in the audience who's talking to LPs finds that it's an integral part of their conversation.
Interesting. I'll come back to that part in terms of what are the flip sides of that in a short while. But just jumping to Aparna, you have a interesting, fund co-investments and direct investments, which are two separate strategies altogether. And BII has also invested in many funds in India over the years. How has your experience been when you look at co-investments where there is a limitation of access possibly, or it's still coming up, and then you have a direct investments which has its own evaluation process?
Yeah, so both are very different processes for us, and I think when we look at co-investments, the most important thing we assess is the GP. It is truly a passive role that we like to play in that strategy. So we would assess the GP for its capabilities on commercial, on ESG, on business integrity, also governance. So that trust and that conviction on the GP would be the main driver for us to do a co-investment with that GP. In terms of process, I think it becomes much more easy and simpler if there is alignment on a lot of things. Alignment on the entry price, on valuation, on the rights, coming in at the same time with them, having the same holding period or similar holding period as them in terms of the stage of their investment, where they are in their fund versus for us when we are coming. So I think those alignment things matter a lot. Also the DD, if they are doing it as a follow-on, or is it the first time they're investing into it. So I think if these things are in place and there is good alignment, then the process is much more seamless. And in case the alignment is not that much, then of course there can be a bit more complication around it. Because obviously what we don't want to do is go down the path of a direct investment where we are doing our own DD and spending a lot more time on something like that. And as we understand, many of these opportunities are very, very time sensitive as well.
So just picking on that and going to a GP perspective, Ashish, for a minute. As Aparna was saying, typically from an LP's perspective, you also want to kind of look at the opportunity and evaluate. But as a GP, you also have limitations. Entrepreneur is also asking you to close the deal soon. Operationally, what are some of the roadblocks or best practices that you have seen in implementing these co-investments?
Yeah, so I would say that maybe there are two consideration points that we think about, right? So one is that at the time of entry, right? So the way I have seen, we have done it, and the way that a lot of people actually do that is that after the diligence, when the term sheet is issued to a company, there is a particular time window. Typically, it's a short time window, a week or so, right? And that is when, depending on who the co-investment partners are, that information is shared and say that, hey, this is primarily a lot of the diligence that we have done. You could potentially have one conversation with the founder, and then you have to commit yes or no, right? We don't have, honestly, a lot of time for diligence from there on, right? If as a GP, I am aware of the fact that there could be some of my LPs who are potential candidates for investment, I would actually negotiate the term sheet accordingly, right? So the way that we operationally that we do that is that after a while you get a sense of which LPs will be interested in which type of companies, right? So there's a little bit of pre-vetting that kind of happens, right? So that's one. The second is, I think a better way to kind of look at this entire co-investment and direct investment is from a founder perspective, because really, whether we are a VC or whether we are an LP, we are in a way derivative industry, right? The real value creation, bulk of the value creation is happening at the founders level. What they are saying is that I want people who can, of course, besides capital, add value. Number one. And number two is that their time horizon on how they think about exit has to be reasonably aligned. So the second is where in the co-investment there has to be a conversation on alignment of when the exit should happen. So operationally, the good practices are the ones where the exit is tied together for both the co-investment vehicle and the main GP vehicle through which investment is happening. Because any time there's a difference in the time, it is an issue for the founder. It puts stress on the company, and nobody genuinely wins. So I would say those are the two things, best practices that I've seen.
Got it. Thank you. So Jay, just picking on that, Ashish just mentioned timing and alignment at the same time is important, but that doesn't happen in all the cases, right? You have opportunities where possibly there is a limitation of capital that can go in the same round, but you have a great relationship with the GP, you have a co-investment in a subsequent round. As a family office and as an LP and representing family office perspective, how do you see that opportunity where there is a small misalignment in terms of the timing, but it's still a great opportunity because it's coming from a relation?
It's a difficult one. The reality is, I think the most sophisticated family offices or the LPs, institutional guys, get it and they understand it. I think a lot of family offices do the piggyback check. So if it's a smaller check, they'll say, okay, we did a call with the founder, visit to the office, visit to the factory, visit to the shop floor, whatever is required. But I think that's where a lot of things also drop off. Because say you've got to close this in 2 weeks. This is what happened in 2021. I got a whole bunch of calls. There was so much money and there's so much opportunity. This deal's being done at 3 billion, it's going to go to 20 billion, blah, 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 come on board. The one thing we realize, and you realize that family offices, the first mandate given to the head of the family office or the CIO is don't lose my money. I'm not going back from where I came. Right? So don't mess with that money. And nobody penalizes you. So you've got to also understand the psychology of a CIO. See, I am in the unique, enviable, and sometimes not so enviable spot of being a family member running the CIO hat. Right? I can also be blamed to be the uncle that blew up all the money, right? So that's not a thing you want to live with. But on the flip side, I can also say, let this one pass. I'm just not comfortable. We spent half a day on it with full respect to the GP and the opportunity. You say, this one will pass. And nobody's going to say, why'd you do that? So I think it's delicate. I think this is where domain expertise, and coming back to Ashish's point, is to know your LPs. And I think this is something, honestly, the entire GP community should do. They don't just take the check. Spend time with them, understand what are the sectors that these guys are great at. Because having an LP jump in, somebody who's building buildings or has 10 million square feet of commercial available, and you're doing a prop tech deal and you don't show it to him or send the CEO to him to just have a chat, I mean, it's a shame. You gave you 20 crores, but you didn't really harvest. So I think this is something the community has not done. I've been an LP for 15 years, and I don't see my VCs and PE friends do this. They don't really mind the family office guys. And think about it, you've got a patriarch who's 65, 70, he's a machine. He's built a billion-dollar company. You think he will dissect that opportunity in 10 minutes flat, right? And will say, I like it. I'll take majority. The next question you're going to get as a GP, which you have to manage, is I want majority on this, right? And that's the stuff you have to deal with aggressive sort of business families.
So, Sachin, you look at co-investments both on the upstream and downstream. It's actually doubly complicated. But having said that, it's a great opportunity because it's also in a stream of the Indo-Japanese alignment that you look at. Any best practices that you have seen in terms of operationalizing co-investments, which takes care of the expertise as well as the timeliness of the closure of deals, while you're also catering to both sides of co-investment commitments?
Sure. So both sides, you mean, of course, to our LPs, as a fund of fund, we have given them co-investments when we invest into a new opportunity. I agree with what Jay said. In 21, we were also getting co-investment opportunities and press a button and wire the check. That's not going to happen. I think majority of the LPs may not be able to do it when the asset class is new, the experience is new. So unfortunately, I'm yet to see best practice at the VC stage. Of course, Ranjit may share experience more at the private equity stage, which is more evolved, matured, and seen a couple of cycles now. But in the venture space, honestly, we are just seeing few funds which have finished their 10 years. They've just seen first round of exits, right? Actually, VC innovated Opportunities Fund because there were not that many LPs who were coming in and doing the co-investment. Had they been doing it, there was no need for an Opportunities Fund, to be honest, because then you could get your LPs aligned to your portfolio and further compound the relationship. So unfortunately, not seen much best practices as yet in the co-investment side. What is desirable though, is an early access. Make use of your LP, mine the LP. That's the right way to do it. What Ashish also suggested, the domain side of it. For us, we have large network of Japanese corporates, both financial institutions, across sectors, right? And if you have a founder who's in, say, enterprise tech, SaaS, B2B marketplaces, who has, a view on Japan market, wants to tap into that market, probably an early access, building a comfort, will go a long way when actually the deal comes to the table and materializing it. So, I think the VCs will catch up. The mix of the LPs is also changing. Earlier it was largely more family offices, but now there are fund of funds, DFIs, and various category of LPs. So they will all bring in their mix, experience, and perspective on how to run them. What our view has been, because the VC ecosystem is still very young, we've not seen many full cycle. We believe in something called as active co-investment and not passive co-investment. Right? We believe we could really complement the GPs, not just in consummating a round, but the second leg, which is adding value. So we believe more in the active co-investment. That's where majority of the family offices also can also have a similar perspective, in my view. So yeah, that's my 2 bit on that.
Got it. No, thank you so much. So just to kind of conclude, we've all seen, co-investment by and large, everyone agrees that I think that is an opportunity here to stay. There is obviously operationally, there are some challenges, but I think there are ways to kind of streamline along the way. In private equity, it's more kind of mature. VC, it's kind of happening. And as a VC where I have seen my 2 cents, I've also seen that as long as you're doing it in a very structured manner, where the operational parameters are also well defined in advance, and ultimately the entrepreneur or the founder is choosing where they take money from, it is always aligned. And of course, exits are yet to be seen. So the proof of the pudding is yet to be seen on co-investments by and large in the VC stage. So one last question to the entire panel. Maybe we can go with Jay. So if we have to make, say, co-investments and direct, sustainable, and work alongside, what is one thing which is desirable in the implementation or expectations, both from a LP and from a GP side?
Process. Just be upfront, be transparent, set a process. As a GP, very transparent. If there is a fee, let's talk about it. If there's a process, there's a timing, and what you expect from that LP as well. I think nothing beats that. Today there's a lot of ambiguity. Some people get it because they're close to the GP. Some people don't get it. Some people put big checks so they get it. So I think just set a process, have a document. When you go and talk to your LP, say, listen, man, this is what I can give you, and this is what I can't give you, and it's in my, whether you want to put it in your PPM, it's a different story, but set a document.
Aparna, one.
Similar, efficiency.
I think the GPs have to right-size their fund on day one when they launch, so that the elements of co-investments can be articulated well when they are marketing to the LPs. I think if you get your fund size right, then naturally the next question is what kind of opportunities will emerge from this relationship and how the co-investments will really come. And then everything that my other panelists just said, process, transparency, the parameters. And of course, the LPs also have to be very clear about their objectives, and they have to engage with GPs and let them know, what areas, they are looking at, what kind of opportunities they are looking at, so that we also understand the founder ultimately takes the call, and we want to make as smooth a transition as possible, and not create any frictions in the process.
So no frictions, transparency. Ashish?
Yeah, so until there is a predictable path to exit for the companies, I would say aligning on the exit is one thing that needs to be done to ensure that the co-investment is sustainable.
And in addition to what everyone said of having the framework set appropriately in advance, I think we should all remind ourselves that it's co-invest, which is trust the GP. And a lot of this has to flow through the GP, rather than seeing it as an abs initio investment exercise.
Excellent. I think we are out of time. Thank you very much for an engaging session. I hope we were able to kind of cover a decent number of topics. Thank you very much. Thanks for this opportunity as well.